Good afternoon, everyone. Happy Friday. Hope everyone's staying safe. I'm Justin Bush. We're back here this week. I'm with Cardinal Financial. I'm the market leader here. And this week we've got Brian Smith from Berkshire Hathaway Home Services and EWM Realty, who is going to take us through some of his experiences in our current condo market. He specializes in this market. So, Brian, I'll let you kind of give us a quick little overview of yourself.
Hey, thanks, Justin. I appreciate it. For all the geeks out there, I'm an electrical engineer. I'm a former Navy officer. I focus on helping busy professionals, athletes, first responders, and vets, and realistically, anybody that's looking to buy or sell a home. My focus markets are Edgewater and Miami Beach. However, I have been out looking at properties everywhere between Homestead and North Broward. So excited to answer questions and talk on today's call here.
Yeah, so you got a real well-rounded knowledge of the market as a whole when it comes to especially Miami-Dade County. Obviously, being so much condo in this particular market where our office is and where you reside, so we're going to have a condo-centric focused conversation today. And also, you guys probably saw, we just had our guest and interviewer join us in Sean Stockell. He is the publisher for YourHomeOneSource.com. Guys, this is a fantastic platform. I'm really excited that he got to join us here today. Sean, without further ado, I'm going to let you tell us a little bit about YourHomeOneSource.com.
Okay, Justin, thank you. And Brian, I appreciate you all allowing me to join the discussion today. And so I spent over 30 years in mortgage banking business and community banking, and we developed Your Home One Source to be the first resource platform for anything and everything home. So it's not a single vertical like you would with a Zillow that's primarily focused on listings and some mortgage banking, or an Angie's List or a home advisor in the repair area. It's not like that at all. Your Home One Source is all about educating and informing people on anything and everything home. So we've got a lot of content. It's a massive website. There's over 800 pages of content. There's a search bar at the top of every page where somebody can type in whether it's loans, buying, selling real estate, remodeling, building a home, insurance, you name it. We have articles, I think now approaching 375 articles, 22,000 outbound links. It's really quite a resource portal. And so our objective is to help people make better decisions on home-related matters, and then connect them to good solutions. So that's what we do.
It certainly is impressive. Brian and I have been going over it for a couple of weeks. I know that Brian's been working with you for going on over a year now, right? So and Brian's written a few articles for you guys and things like that. So I was going through some of that content, and you really do take a very organic approach to delivering what is real quality information to the consumer. And I think that that's what happens a lot of times is people don't know if they're being advertised to when it comes to specific types of information, things of that nature, and where does that content really coming from. But your approach obviously sheds that uncertainty, when it comes to understanding what that information really means and how reliable it is.
Thank you, Justin.
It's good stuff.
Guys,
we're going to go through 4 topics today as usual. Today we're going to talk about the COVID-19 challenges when it comes to condo buying and selling, the strategies to get a good deal on a condo, and the best practices in selling a condo in this market and under the circumstances. Also, present day residential mortgage loan myths and realities. That's going to be our third one. And then last of all, the opportunities, what to look out for. And, is there an opportunity that you can be proactive about now so that you're setting yourself up for, your future or new opportunities down the road. All right. So I'm going to I'll let you take it away, Sean.
Thank you. So, difficult times, right, for all of us. Maybe that's the understatement, COVID-19. We look at what's happened to our lives in the last 45 days, and it's quite a challenge for everybody. And so, in the area of real estate, Brian, we'll pick on you first. So what are you seeing there in your area, in your marketplace? The challenges for buying or the sellers as well within the COVID-19 world that we're now in. So what are you seeing the challenges, and then how are you addressing those things with your buyers and sellers?
Yeah, I think we start at A in the alphabet. So access is the number one challenge that I'm seeing, whether it's for the buyer or the seller, because really they're on the same team at the point they're trying to get the property sold. And, it kind of reminds me of being back in the military. It's sometimes hard getting on a ship. Right now, getting some of these condo buildings, walking through the quarterdeck, walking through the reception desk, everybody coming in the building has to have masks on. You got to be cleaning your hands. And if you don't live there, a lot of times you can't get in the building. So, access is really a big challenge right now, whether you're trying to buy or sell a property.
Right. Yeah. And the all of the quarantine, whether people even want to allow someone in, obviously. So what are you doing? Justin, we'll kick it over to you for a moment. So in the lending world, what about access for the appraisers? The same thing. Are they limited or no access to a property?
Yeah, I mean, I think that, the limited access to the condos themselves is a warranted approach, right? I think that we all have some responsibilities here, whether it's being forced by the condo itself or becomes a municipality approach, whatever it is. So you're right, getting someone in to something that's not considered essential or for essential purposes is going to be a little more complicated. And how do you justify an appraisal as an essential need to be able to get access, or because you want to buy it and you want to see the unit be considered essential? And also too, if there's people that are going to be occupying that space, the people that are coming into that space and the risks that may be associated with that, or the flattening we're trying to approach this with. So the good news is that appraisers we've come up with new appraisal options, and more so than anything else. So we'll talk about purchase, and then we'll talk about refi. So on the purchase side of things, more so, we are doing what is just a drive-by appraisal. We just want to see that the building's still standing. We know enough about the buildings. There's enough information on the web about what that unit looks like, and ultimately, from an appraisal standpoint, about 99% of the time, we're going to allow a drive-by appraisal when it comes to accessing a condo building. Okay, so that's one on the purchase. When it comes to the refinance, what we're seeing in many cases, especially if it's just a rate term, so if you're just reducing your rate, or you may be changing the terms of your loan, maybe going from a 30 to a 15-year, in these cases, we are seeing about 70% of all of those particular refinances actually get appraisal waivers. So what's happened is that our GSEs came together, Fannie Mae, Freddie Mac, Ginnie Mae. They all said, listen, we got to keep things moving. We are comfortable with the fact that we understand the market well enough. We have enough appraisals in most markets that we have records of to go ahead and just waive the appraisal or the need for the appraisal altogether. So not only is the consumer saving money, to the tune of what is typically $500 on a primary residence or second home, $650 on what is an investment property. In those cases, if you can get appraisal waiver, and there's less often on the investment properties where you're going to see that full waiver, but you may get the drive-by and you still need to do the rent comparable. But the good news is that we have the solution. It's not halting our capability of moving forward with the transaction from that standpoint.
That's excellent. Yeah, good to hear that Fannie Mae, Freddie Mac, that the guidelines now permit that very practical solution, especially on the refinances, which I would think obviously is the biggest portion of the business right now, right? Rates are low and there's not as many sales. So on the refinance side, that is very important. So Brian, two-part question here. Kick it back to you. So how do people get a good deal? I mean, right now on a condo in your area, whether it's a primary residence, a second home, or an investment property, what would you suggest, an approach? How do people get a good deal in this current market?
Yeah, thanks, Sean, for asking. I appreciate it. It's really interesting. I get people coming to me all the time and saying, I want a realtor that, can pull out a great deal. And, I'm not going to pretend to have a ton of secret knowledge. But what I do find works really, really well is first get a realtor that knows the neighborhood. For example, I focus on Miami Beach and Edgewater. I've been in the vast majority of the buildings, have a sense of what the valuations are. And so that's a really good starting point. Make sure you've got a realtor that's, knows the neighborhood. The next thing is don't be afraid to make multiple offers, because as you make offers, you're going to really see, kind of no BS where people at on what they would accept for an offer. And as you get through those negotiations, and in the best way to pull the answer out is make an offer, see what happens. At the end of the day, don't get too emotionally tied to the property. Take it as approach. It's a business, and you're making an offer and seeing if you want to buy the property, and go at it that way.
And I think, and I'll just jump in here real quick, and not to interrupt you, but I think you nailed it, right? Because right now, the more activity approach you have to trying to put an offer on something, well, one seller's situation and another seller's situation could be substantially different right now. This is not the same as it was 2 months ago, where everyone was employed, or different situation where maybe they're maybe the unit was occupied or wasn't occupied. It didn't necessarily matter because the income was strong, and now they may be feeling a little bit nervous about their employment or their income in the long term. So I think that your approach to that is really going to resolve and kind of pull out of the woodwork those new opportunities, right, at a lower price, and people are going to move a little quicker, I think.
Yeah, I think that's right on. Always there's been, people on the buy side are looking for the motivated seller in the comments of the listing, right? And unfortunately, hey, I've been there. I've been the motivated in 35 years. I've been the motivated seller before, needed to sell a property and was willing to, put a good price out there. So yeah, look for those opportunities where prices have come down. So what about Brian on the selling side? So best practices. What would you say are some best practices as a realtor in selling and marketing a property right now?
Well, the first step is the same. Use a local person that knows the neighborhood. The next thing is, in this time where it's really hard to get the access we've been talking about, make sure you use a realtor that's really on top of their electronic game. What I mean by that is use somebody that uses and widely distributes video and high quality photos.
Right.
And I couldn't believe it. The other day I did a study on a building. I would consider it to be probably the nicest building in Edgewater. There's 29 listings on the market. 2 had videos in MLS, and one of them was a video I had done. And I just looked at it and I scratched my head and I went, how is it these people want to sell these homes for, $1 million, 1.5, 1.8 million, and up, and they don't even have a video. Just, the realtor's got 80 listings, and how are they ever going to sell that property in this market? So, make sure you got somebody that's hungry and excited and is really going to go after it and, do a good quality job for you in the videos and the photos. The other thing is rely on a realtor that has a real strong presence on multiple electronic marketing platforms. So email, social media, through broker affiliations. I'd stay away from the person that's got 50,000 followers on Instagram and nothing else in their portfolio. You want to make sure that as you talk to that person, they're really canvassing multiple social media, email, and broker platforms. And then be really realistic on pricing. And that's, your realtor could do all those other things, and if you're not realistic on pricing, they're just going to spin their wheels. So you as a seller, be committed to the cause that, if you're going to sell, you got to be realistic on the pricing, because, for every condo in the market, there's probably 10 others very similar. So.
Right.
And actually, I kind of got a question in that regard too when it comes to selling. So if you're the listing agent and you're taking in offers, how do you approach the whole? Is your buyer that you're bringing me truly ready to purchase? How capable, willing, able, capable of being able to perform? from that side.
You're saying if I'm the listing agent?
If you're the listing agent and someone brings my offer to you, you know, how do you typically, you know, how are you verifying the capability of their, you know, ultimate?
One way is to look for, you know, an automated underwrite with the offer, because that way we know we're not going to get down the path of negotiating the contract and then we get to the 30-day or the 40-day window for the commitment, and, you know, there's no, you know, the bank's not backing up the purchase. So, you know, one of the things that I would suggest, you know, going back to the getting a good deal on a condo, is make sure the person's qualified before you take them out shopping for a home. You know, and that's the interesting situation we're in with realtors, is you can do everything right, but if the other realtor is doing everything right, you're not going to have a deal. So you got to really make sure you partner with, you know, realtors that are professional and are doing all the right things.
Yeah. So when it comes to, you know, a borrower qualifications or qualified buyer, you know, there's several different or a couple different versions of this, right? There's one where, you know, where maybe myself as a loan originator may take the application, underwrite it to the best of my capability, run it through an AUS, but maybe it hasn't touched the underwriter's desk, and that's going to be what is a pre-qualification. We also, you know, at Cardinal and many other lenders do the same, is they offer what is a pre-approval. So you can actually get a loan, have it underwritten prior to even having the property picked out. So taking some conservative approaches to price, down payment, things of that nature, HOA dues, what we think the taxes might be, insurances, things like that. So that if you get one of these, you know, that's a really, really, really strong qualification compared to just a pre-qualification, because it's already hit the underwriter's desk. At this point, we just need to plug the property in, tighten up the numbers, and, you know, it's a breeze at that point. So, you know, that can make a huge difference, you know, especially if you're talking about a multiple offer situation. You know, if, you know, side by side, same offer, pre-approval versus pre-qual, you know, that's something to consider as well.
Yeah, and I'm also going to look at, you know, when I read it, what's the name on there, and see if it, you know, is this a name I recognize, or is this a fly-by-night mortgage person I've never heard of? You know, so I do pay attention to those things, and yeah, obviously cash is king. You know.
Yeah, of course.
Yeah, that's why he's bringing to me, but you know, the vast majority of people will need a loan.
Right. Well, guys, and Justin, for you, there's been so much that has changed in finance in the last 30 days. There's a lot of, I would say, negative news out there. But you know, what's the reality of all of this? Is it really that bad? The changes in the state of the mortgage industry right now?
It really is not as bad as you see. There are certain specific loan products that have really been hit hard with this. So anything that was that non-QM space. So, you know, there were some stated investment types of loans that were out there that were still priced really well from an interest rate standpoint, meaning they could be falling into the, you know, fours on an investment stated type of product in some cases. So that loan product is gone. The bank statement loan product is gone. The foreign national loan product is quite limited. You're only going to have a small number of portfolio banks doing a very specific product set around that. They are tightening their guidelines almost on a daily basis from LTV, just to reduce risk overall. So that stuff has really kind of gotten tight. The jumbo market has also been substantially hit. Right now, the best place to get a jumbo loan really is going to be at your bigger, big banks, even though they're going to be the tightest as far as underwriting. So they're going to be quite conservative. So you're looking at their rate, not their rates, their guideline qualifications. You're looking at, they're going to want to see much better credit. So if they were doing 680 before, now they're probably wanting to see a 720. So you're going to have to do some digging, do some real research to find the right type of jumbo product right now. But that said, everything else is actually quite business as usual, at least for Cardinal Financial and the larger GSE direct lender. So a GSE direct lender means we take the loan, we fund the loan, and then we package it up and we sell directly to Fannie Mae, Freddie Mac, Ginnie Mae, however it may fall. Right. And so, you know, in those cases, you'll see that we're still running 620 credit scores across the board on conventional. We did do a little bump on our FHA, so we want to see a little better credit. So now we're going to be at 620 on FHA. But there's not been any tightening as far as the LTV restrictions go. So we didn't change, nothing has changed as far as loan to value. So you can still get on a primary residence, a 3% down conventional loan, a 3.5% down loan on an FHA transaction, and a 0% down on a VA transaction, assuming it's a primary.
Right.
Right now, you can still cash out to, on a primary residence, even on VA, up to 90%. So, again, it's not nearly as bad as some of even the big banks are talking right now. You see some information that comes out about Chase is limiting what they're doing with their correspondent lines. So what they're doing is they're just pulling away from a risk part of the market for them. So they're only wanting to do their retail product. They don't want to be in the wholesale business right now. And that will probably change as things level off and kind of get back to normal in the next few months. But for now, people are just kind of, especially the bigger banks, are just looking to hedge their risk as much as possible. But, from a Cardinal Financial lending standpoint, we're as aggressive as ever. If we get an AUS approval, we're not adding any additional overlays. The one thing that you will see that is going to change a little bit is that we're going to, if you're self-employed, you're going to have to fill out a questionnaire. We're going to want to be able to see that you're still able to do your job. So if you own a restaurant, maybe a little bit more difficult for you. So unless you say, I've converted all my business to takeout, then you might not be able to get that loan. So as long as it's set up the right way and you take the right approach, you got the right professional consultant around you to make sure that your loan is set up appropriately, it really is business as usual.
Good.
The bigger challenge being obviously unemployment. Those on furlough, you're going to be on hold until something changes, but it's not going to affect your ability to get a loan in the future. It's just going to change the ability to get it right now. Okay, exactly. So it's not considered negative other than you just can't do it right now. Once you're employed again, we don't care about the past.
Right, and hopefully that window is not too far away. So real quickly, we talked about access to properties, and then also we've been covering on the refinance side. So maybe you could explain for viewers or listeners the opportunity around the VA IRRRL. What can you explain there?
Okay, so the VA IRRRL, and I think we were kind of talking before we jumped on this call earlier today. Brian's a vet, and he threw a number at me a couple weeks. Was it a week ago, Brian? I think you shouted a number at me that 18% of. I'll let you do the exact number because you just read it. So give it to me, Sean. What was the?
Yesterday, at 18% of transactions, and so it's a lot higher than I thought it was.
Are to vets?
Yeah, to veterans on the VA side, and now. I'll be honest, I'm not sure what percentage was purchased versus refinance, but I know that on the refinance side, that the IRRRL product, that's what it's for, is a huge benefit. And since rates are at all-time lows, just wanted to highlight that, especially the fact that no appraisal.
Yeah, so no appraisal. We're not going to check your income. So we literally are just going to go off of nothing but verification that your mortgage has been paid on time. And this loan can be done one of two ways. It can either be done as a mortgage only with a credit score or mortgage only without. So you get a little better pricing from a rate standpoint if it's with the credit score. Right. And then without, it obviously is going to have a little different in pricing. But the reality is that this is about the easiest loan in the world. So if you're a vet or you know someone that's a vet, this is a very, very quick, easy close. Again, no appraisal, no income verification. It's boom, 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 and we're off to the races. It closes typically in about 2 weeks. That's a very, very fast-moving product. And plus, it's designed to help those who really have fought for our country and those service men and women.
Right. Yeah, it's a great program. Just wanted to mention that. And really, for both of you, this final question, we'll start with Brian, with you first. So, from a financial perspective, what do you expect will be some opportunities that will be coming along in the next few months, given the environment we're in? What would be some of your recommendations from a financial or an investment perspective? What do you see ahead?
If anybody wants to talk to me offline, I think there's some really neat things that could be coming up for opportunity zones, or somebody's into doing 1031 exchanges. And, it's kind of it's a challenging conversation all on its own. We could take up an hour talking on
Right.
those two type of vehicles, but if you do have interest in 1031s or learning more about opportunity zones, please give me a call, 305-318-8200.
And Brian, I think that it's safe to say, though, that while property values are holding right now, because it's hard for us to transact the purchase and sale transactions at the same pace we had previously, is it safe to say, and do you think that we're going to see these prices or the values kind of at least take a dip in the short term and to the point where that could create new opportunities for investment?
Yeah, I mean, I think for sure we're going to start to see prices drop. I mean, I've had people ask me for the last couple of years, should I sell my property? How long should I wait? Well, a lot of people, I said, if your horizon is a couple of years, sell. If your horizon's 5 or 10 years, hold. And I think we're going to start to see those prices come down here. We're kind of at that phase right now. The tricky part that's really hard to understand is you really got to dissect the market. And when I say the market, it's the neighborhood and then it's the price bands.
Right.
And that's the thing that's really hard for people to understand, because they go, wow, I thought it was an ultimate, buyer's market. Well, it could be some tiny neighborhood where there's not a lot of inventory in that exact price point they want. So the best way to do that is dig down and look at what your specs are you're looking at, pull up all the listings and all the sales and, see what's happening.
Well, that's where you come in, right?
I can print up all the fancy graphs and show
yeah, and you're going to help us understand what the return on investment is there too, right? So if it's an investment property, which I'll just roll into where I believe that people should be taking advantage of right now, is that if you have any sort of real estate investment vehicle and you can qualify to get cash out of that property right now to set yourself up for, a simple safety net if that's what you need, to continue to employ employees if that's what you need to do, or ultimately to give yourself the investment opportunity in 3 or 6 months whenever that unit dips and it hits right where you want to be, and you're able to get that seller who's now motivated, just like Sean said, now you got the cash on hand, you're ready to go much quicker. You could already have your approval in hand. So set yourself up for success to make that opportunity come to fruition.
And Miami is so interesting because you have, some properties here that are really, really valued high. So, I've seen people go and sell their property for a few $1 million, still be able to go out and buy a nice property and turn around and do something with the other cash commercially for their business. So, now's the time to really think about capital and capital expenditures and taxes and how you want to do all those things, because a few good decisions in the next, 6 months to a year could lead to a huge return over the next 10 to 20.
Right. And one other thing too is, and I know we had talked about this before, is pricing the property right and aggressively. With what could be coming for a few months, the serious seller has got to be ready to be priced aggressively. And we saw this maybe 10 years ago with the last cycle down in the housing crisis, that it's really hard. I always say it's really hard to chase the market down. So if you're trying to sell, and you want to get something done, you've got to lead, you've got to price right. So.
Yep, 100%. And I was just reminded about something, and it really doesn't fall in line with what we're talking about. But when it comes to the VA loan, and I don't know that the majority of our realtors or audience as a whole know that there is no longer what is a conforming loan limit for VA. So VA actually will go to $2 million on a VA loan, which is not, we can't do a conventional loan in the state of Florida above $510,400, but a VA loan will go to $2 million. So that's something that a lot of realtors aren't necessarily aware of, and there is a huge opportunity for that service man or woman to take advantage of that. And I don't know that they know that sometimes. So I just want to remind everyone that that is something that keep your eye out for.
Yeah, and at 100%, is that limit?
Zero down payment.
That's your phone.
Just to $2 million.
Yeah, get ready. Your phone's going to ring.
Yep, to $2 million. So,
Good.
So Brian's selling houses on the water. So it is going to be very difficult though to do a condo for a VA, just so we're on the same page. VA and condo don't necessarily go real well together.
Right.
That's traditionally had been the case actually for FHA as well. And then FHA over the last, it's been in the last year, it's actually been the last half a year, has now allowed for FHA spot approvals. So as long as their reserves are strong, so if you got that borrower with that lower credit spot, or they need a higher debt to income ratio push, then they're going to have maybe a new opportunity in the condo space. Not that there's a huge separation right now in credit scores for FHA versus conventional. So something to keep in mind, but down the road, especially as things kind of lift back off the ground again, I think that would be an opportunity. We're going to see a lot become more aggressive. I think that FHA is going to do more condo approvals, and they're going to make it easier for people to qualify in the condo space.
Excellent information. Thank you.
All right, guys. I think at this point we're about ready to open it up for a Q&A. I did see one that came in. Carolina asked about reserves. So as far as reserve requirements go, FHA came out with a directive, I want to say it was about 10 days ago. They said, we recommend that you as a seller servicer collect 2 months of reserves for an FHA property, because the majority of people that are FHA buyers fall into the lower credit buckets, and those lower credit bucket people maybe are, on average, in jobs that are not going to be able to maintain through the actual COVID-19 situation. So they have to be furloughed, they may be laid off. So, and it's just based on sheer numbers over historic understanding of the borrower in the FHA space. So FHA has recommended seller servicers have a 2-month reserve. So that is something that we are requiring at Cardinal. Not necessarily is everyone required to follow that. So I don't know what everybody else is doing, but we're doing 2 months. We want to protect the house. We want to make sure that we're still in a good position with all of our, all of our purchasers and our insurers, so to speak, because that's really what FHA does. They insure these loans. So that's the only one, though. Nothing else has really changed as far as reserves go.
Good deal.
And let's see if we got another one. Liz, you see another one come up? Let's see. Financing options for people. Financing options for people who have lost their job. You're not going to be able to get a loan right now. I think I covered that a little bit earlier. It's going to be difficult to get a loan without a job right now. So unless you have a borrower that really is still employed or has that income or is capable of making that payment through some other way, that you're not going to get a loan right now without having the income. Even if unemployment is in play and we're getting some government help, it's not going to be something where any lender is going to get comfortable with where that's going to be in 6 months. So, yeah, another one, Liz. Let's see here.
When do you expect more opportunity listings in the market?
When do you expect more opportunity listing on the market? I think the question, and I don't know what the question is or who posed it, but I think the question is, when will activity resume? So I'll let you go to that one, Brian, because that's in your field. So they say, at lower prices. Okay, so
I think
I'll let you take that one.
This is what we talked about earlier, is we find out when we make the offers, because you've got one person who lists the property at their absolute lowest they're going to accept, and then you've got another person who lists the property with the idea that they're going to negotiate. And the sellers don't always, no matter how many questions we ask and how much qualifying we do as realtors, they still don't tell us, at the end of the day, what all the data points are.
Right.
So the way you find it out is make an offer, and you find a property you like, and you may have to go through multiple offers.
Yeah, so I think that you nailed that earlier in the conversation, which is, doesn't matter what it's listed for, right? It matters how you approach it right now, because I think that you're going to drive motivation as a buyer now more than ever before, right? Because the sellers may not even, the sellers a lot, in this case, in a lot of cases right now, they're just kind of on standby. Like they don't really know what to do. Their arms are kind of up in the air, depending on who the real estate agent is. That person may not really be taking a proactive approach to the situation and keeping things moving. So I think that you nailed it earlier, which is get out there, make your offers, and see what you can win. Let's see. Do the VA loan guidelines also apply for refi? Do the VA loan guidelines apply for refi? It depends on the type of refi. So the VA has to, I think we covered this with the Earl, but there are a number of different types of VA loans. So you can do a full qualification refi if you needed to. That would be the case in a cash out. So that's going to require a full qualification. We're going to want to see your income, full credit report, all of those things. We're only going to go to 90% on that. When it comes to a rate term, it doesn't necessarily make sense to do anything but an Earl. The pricing is the same and the loan is just as much easier to do it as an Earl. Why would we do a full qualification as a VA full qual? So in that case, it depends. A refi, it's easier unless it's cash out, then it's the same as if you were purchasing for the most part. Are lenders offering forbearance only, or are some offering deferment? Okay, so let's talk about this. We were talking about this one earlier. Our directive at Cardinal really is very straight to the point, which is forbearance is not forgiveness. If you're looking at deferment, you have to speak to each individual servicer. So where Fannie Mae and Freddie Mac said, hey, if we own this loan, if we're the investor for this loan, we will allow a forbearance. They really do rely on the servicer to determine how that forbearance is going to be repaid. And I'm going to give 3 examples. This does not mean that these are going to be anybody's 3 opportunities or how this would work for them. They really need to speak to their individual servicer, so whoever they're making their payment to every single month. So if you make your payment to Wells, you got to call Wells Fargo. If you make a payment to Cardinal, you got to call Cardinal. But if you were, let's just use the example, say you deferred your payment for 3 months, right? So you get to day 90. Well, you might owe all 3 months of those payments at day 90. Right. And if you do not, they will immediately start the foreclosure proceedings the second that goes 30 days. So at that point, you've really gone about 4 months without making your payment, or you're 3 payments behind at month 40. So maybe you made 1 payment. So they're going to start the foreclosure proceedings in that case. Another example may be your servicer may say, okay, we're going to take that 3 payments and we're going to spread it over a 12-month period of time, so that it doesn't feel so painful to have to pay it all back at one time. Because just if we don't go back to work in 3 months, I'm not sure we're doing ourselves any favor by not trying to get that mortgage payment paid on time. The other option may be, and I think that was kind of what Caroline was alluding to, which is the deferment. So if they were to defer it, that means they're probably putting it on the back of the loan. It's a principal curtailment. So they're going to take those 3 payments, stick it on the principal, and in that case, that would be the best case scenario. But that is a servicer decision. That is not a decision that is made by Fannie Mae, and you really have to make sure that you get in writing and you understand very well what the expectations are for your forbearance. Okay, so again, forbearance is not forgiveness. Keep making your payments. If you don't make any other payment, make your mortgage payment, because it really can hamstring you in the future. And we're getting a lot of government assistance right now. Unemployment is really doing their job as far as making sure people are continuing to get paid. So, I think that I saw a number, people are getting about 70% of their income for the most part across the board. And, people should be able to make at least their home payments for that, with that amount of money, as well as be able to live. I think that, we're not taking so many vacations these days, and we have the opportunities to save some money, in certain places. Let's see, any others? So maybe we should look at new listings. This question was, so maybe we should look at new listings coming up in the next month. I think that you're going, this is just my feeling just from being in the financial side of the business, which is I think that you're going to see a lot of people looking to liquidate. Meaning they're going to need cash right now, so they're probably going to be ready to sell their property, or they don't want to be the person that wants to sell it in a year when the values have gone down. They'd rather sell it now. So I think you're going to see people that were kind of, hemming and hawing about whether or not I should sell my property. I think that they're going to be more motivated right now. Like, I don't want to be the one stuck not being able to sell because there's so much inventory. And what do you think, Brian? Is that realistic?
I think the tricky thing is the buyer and the seller, hopefully don't have the same time horizons for the investment. So if the seller's like, hey, I've got to sell within the next 2 years, and the buyer's like, I'm going to hold it for 5 to 10 years, then it may work out that collaboratively between the two of them, there's a value for one to buy, one to buy and sell. But if they're holding for the same amount of time, then that's where, one person would be picking up a bad situation from the other. So, and that's where it's hard, because you never know what the goals of both parties are, and that's where we get into the conversation, making offers, and then really making sure that the buyer knows what it is that they're getting, how long they plan on holding it for, what all their their goals are in acquiring that property.
Yeah, I think you're dead on. I think that there's a lot of uncertainty right now, but I think that there's going to be just as much, if not more, activity out there than we've seen in a while. I just think it's just going to get harder for people maybe to make a decision sometimes, because they're afraid of pulling the trigger too early, or maybe they're going to be afraid of pulling it too late. So I hope that, either way, activity is a good thing all the way across the board, in my opinion. So I think that we'll see a lot of that.
The thing to counter it with, I think a lot of people get in this conversation at the end of the day, hey, I'm buying it as my primary home, so I'm either going to pay rent or I'm going to pay a mortgage. And so, I always suggest to people, look at internal rate of return, talk to a CPA, pull out spreadsheets, and see what your goals are, because it's a lot of times it's kind of the lesser of two evils, and you just got to figure out which one that is and go after it. Because one are high too.
Yeah, we actually had that discussion last week, that there's two different approaches when it comes to purchasing real estate. You have the emotional approach, which isn't necessarily, you're going after it from an investment purpose, but it's because it's going to be your primary residence. You're going to live there. It's the right house for your family. And then there's the one where it is for an investment approach. Not to say that there aren't some potential tax relief opportunities on the primary residence side of things, but two different animals, right? Depending on how you're going to occupy that property. I think that it really is going to really determine, how motivated or how quick they are to counter offer or push back up or push back down. Because I think the investor, obviously, they're not going to budge as much, but the person is purchasing to live there, they may be willing to move around a little bit on that. So I couldn't agree more. Guys, I really want to thank everyone for joining us today. We're going to do this again next week. Liz, can you get up your homeonesource.com up on the screen for everyone? I want everybody to check out this website. What a really cool platform this is. Sean, can't thank you enough for joining us. Love to get you back on here sometime. We'll talk about some renovations and some home building, and maybe focus a little bit more on your website. And guys, appreciate everything. Brian, always a pleasure, my man.
And did I hear next week Kathy Ireland's going to be on the call?
So if you guys haven't seen, as soon as you pull up Your Home One Source, Kathy Ireland is a partner, and you speak to that, Sean. I don't want to misspeak.
Yeah, she's our chief brand strategist.
Okay.
Yeah. But thank you. Appreciate the opportunity to join you guys, and great discussion.
Yeah, absolutely. And guys, you know where to find us. All our contact information will be sent out to everyone post-call. If you ever have any questions, don't hesitate to reach out. I've known Brian for a long time, and he and I think quite alike when it comes to taking a consultative approach to everything it is we do. And we're here to help. And I hope everyone just stays safe. So enjoy your weekend. We'll catch you guys next week.
Thank you.
Hey, thanks.
All right. Bye-bye.
Bye-bye.